Before we get started on this very detailed course, I want to spend a little bit of time with you to explain how to make money with leverage buyouts. Now, let's make no mistake about it. This is a very serious course, and I've spent over 2 years researching and writing it to try to give you all the detail you need so that you understand how LBOs work. But I want to start this lecture and this course with a little allegorical tale that I've created to explain wealth creation process in the LBO world. In a faraway land known as Financia, there lived an astute merchant named Elandor, who was well known for his ability to turn small sums into great fortunes. His secret, a magical process he called Leveraged Enchantment, or LBO for short. This tale revolves around how Elandor used this enchantment to amass great wealth. One sunny morning, Elandor came upon the giant sprawling market of Titanco, known throughout the lands for its endless streams of gold coins that flowed like rivers. Titanco was robust and profitable, yet it lay there like a sleeping giant, untapped in its full potential. Seeing an opportunity, Elandor approached the bankers of the high order with a bold proposition. "Lend me the gold needed to claim Titanco, and I shall pay you back with its own riches," he declared. The bankers, intrigued by this audacious plan, agreed, giving Elandor the vast sum required, mostly through the enchanted bonds of debt, which were heavy and burdensome, but powerful. With the borrowed treasure, Elandor claimed Titanco. He now controlled the giant, but owned only a tiny sliver of it himself. His own small stash of gold was all he had put in. This was the essence of leveraged enchantment, controlling a vast enterprise with minimal investment, using the giant's own strength to steady the weight of the debt. As Titanco continued to spill coins, Elandor used this wealth not just to pay back the bankers, but to improve the workings of Titanco. He polished its operations and enhanced its marketplace offerings. Occasionally, he would even change the structure of the debt to lighter, more manageable forms when the conditions were favourable, increasing the effectiveness of his control over Titanco. Not forgetting the craft of a true merchant, Elandor also employed the arts of multiple arbitrage, buying Titanco at a low price and planning to sell it at a higher one, and wrapping it all in a robust legal structure that made him the undisputed ruler of this enterprise. Elandor also cleverly used the enchantments of tax rules and the alchemy of gap, shielding his riches by offsetting the interest paid on debt against Titanco's golden streams, thus keeping more within his vaults. Moreover, he charged Titanco advisory fees for every piece of wisdom he imparted and every decision he navigated, both when acquiring other marketplaces and when divesting. To spread his risk and multiply his opportunities, Elandor didn't stop with just one giant. He acquired a collection of markets, each unique in its offerings, creating a diversified portfolio that ensured his wealth against misfortune. And so, to expand his ventures even further, Elandor founded the Guild of Private Equity, a magical fund that attracted other wealthy individuals and entities. They entrusted him with their gold, drawn by the promise of sharing in the profits of his enchantments. For this service, they gladly paid Elandor a steady stream of gold as management fees and a portion of the profits. Through this grand design, Elandor transformed his small initial investment into a treasure trove, proving that with clever use of leveraged enchantment, a bit of risk and a lot of wisdom, even the smallest stake could control empires and command fortunes. Thus, Elandor the Merchant became Elandor the Magnificent, a legend whispered in the corridors of markets and bazaars across Financia, a testament to the power of financial acumen and strategic leverage. All this, of course, sounds very unrealistic and fairy tale-like. It was meant to be. So let's tell the same story now, but change the style into an MBA case study. This case study examines a fictional leverage buyout, LBO, executed by Elandor, a seasoned private equity practitioner who successfully acquires Titan Co., a large and profitable company with substantial cash flows. The LBO strategy employed by Elandor involves significant financial engineering and operational improvements to maximize returns. The case study explores the complexities of LBO financing, the importance of operational enhancements, and the strategic exit planning required to realize gains in a private equity environment. Let's look at the background. Titan Co. is a leading player in its industry, characterized by steady cash flows and a dominant market position. If you're not quite sure what this might be, think RJR Nabisco. Despite its strengths, there was untapped potential for efficiency gains and profitability improvements. Elandor, looking to expand his portfolio and leverage his investment expertise, identified Titan Co. as an ideal target for a leveraged acquisition. Deal structure, acquisition financing, debt. Elandor approaches several banks and financial institutions to raise a significant amount of debt, accounting for a substantial portion of the purchase price. Equity. A smaller portion of the funding is covered through equity primarily contributed by Elandor's own investment firm. Financial leverage. The deal structure predominantly features high financial leverage, maximizing the potential returns on equity invested by minimizing the initial cash outlay. Legal and tax considerations. A robust legal structure is established to provide Elandor with control over the company and with the necessary veto powers. Tax strategies are implemented to maximize efficiencies, particularly focusing on offsetting interest expenses against corporate income to reduce tax liabilities. Post-acquisition, Elandor implements a series of operational improvements aimed at enhancing Titan Co.'s profitability and market position. These include cost reductions, streamlining operations, and possibly expanding into new markets or product lines. The operational strategies are critical for increasing the enterprise value of Titan Co. for a successful exit. Multiple arbitrage. The purchase is made at low multiples of earnings before interest, tax, depreciation and amortization, EBITDA, with an aim to sell at a higher multiple. This strategy of multiple arbitrage is intended to capitalize on the improved earnings and operational efficiencies during Elandor's ownership. Exit strategy. Elandor plans for several exit scenarios, including a strategic sale, an initial public offering, or a secondary buyout. The exit strategy is crucial for realizing the value created during the holding period and is a significant focus of the LBO's overall investment thesis. Management and advisory fees. Throughout the investment period, Elandor's firm collects management and advisory fees, providing a steady income stream while also aligning the interests with the performance of Titan Co. Portfolio diversification. Elandor mitigates investment risks by building a diversified portfolio of companies, thus protecting against sector-specific downturns and market volatility. The formation of a private equity fund. To scale his operations, Elandor establishes a private equity firm that raises capital from external investors. The investors are offered a structured return on their investment, typical of PE funds, which includes management fees, 2% a year, and a share of the profits, carried interest, normally 20%. With hindsight, Elandor realizes that this should have been his first step. Discussion points. Analyzing the risks and rewards of high leverage. What are the potential pitfalls and how might Elandor mitigate these risks? 2. Operational improvements. Which specific operational strategies should Elandor prioritize to ensure the maximum increase in Titan Co's value? Exit strategy evaluation. Number 3. Which exit route could potentially offer the highest returns and why? 4. Ethical considerations. Assess the ethical implications of financialeering and high managerial fees in LBOs. Conclusion. This case provides an extensive framework to understand the intricacies of LBOs, the strategic use of leveraged finance, and the importance of operational management in private equity investments. It prompts discussion on balancing aggressive financial strategies with sustainable business practices and ethical considerations in high-stakes investment environments. This course will share with you the detail behind this financial engineering. How LBOs work might have been another title. So if you want to understand how LBOs work and how to make money with LBOs, then just carry on with the course. So there you are. That's my introductory lecture. A little bit of whimsy to start, but at the same time, a very serious message. Leverage buyouts are extremely complex, complicated, and the devil is in the detail. But you have to be able to buy the right companies, understand the financial engineering, be able to do all the mathematics and the numbers. You need to put into place a robust legal structure so that you can control the company. And then you need to buy low and sell high in order to maximize your exits and get a decent return on your investment. And that is what this course is all about.